Ladies and gentlemen, let me ask you a simple but powerful question. What do the biggest players do when the game is about to change? They don't wait for headlines. They don't wait for permission. They move early, quietly, and decisively. And right now, the message coming from the deepest corners of the financial system is loud and clear. It's over. The old playbook is breaking down. The era of easy paper games is fading. Banks are shifting their posture, unwinding risk, dumping short positions, and stepping into something far more real: physical assets. This is not noise. This is a signal. And if you know how to read signals, you know that moments like this don't come often. Major banks are quietly but decisively reducing their short exposure, and this move is far more significant than it appears on the surface. Short positions thrive in environments where liquidity is deep, confidence is high, and supply is assumed to be endless. That assumption is now being challenged. As volatility rises and structural pressures build across global markets, holding large short positions no longer represents intelligent risk management. Instead, it represents vulnerability. Banks are responding not because they are afraid, but because they are disciplined institutions designed to survive regime changes long before those changes become obvious to the public. What makes this shift especially important is the timing. These adjustments are happening before widespread panic, before official narratives change, and before retail investors are even aware that the ground is moving beneath them. That is the first hook you must recognize. The most powerful signals in financial markets are never announced loudly. They show up in positioning, in risk reduction, and in the quiet unwinding of trades that once worked perfectly. When banks begin to close shorts en masse, they are acknowledging that downside control now matters more than upside speculation. Another critical hook lies in what short positions truly represent. Shorts are bets against scarcity, against disruption, and against sustained demand. By stepping away from them, banks are effectively admitting that the probability of supply stress has increased. Paper markets function smoothly only when confidence in settlement and delivery remains unquestioned. The moment that confidence weakens, short exposure becomes a ticking clock. Banks understand that time is no longer on their side, and they are acting before pressure turns into forced liquidation. This behavior also reflects a broader shift in capital preservation strategy. In uncertain environments, banks prioritize capital efficiency and balance sheet stability over aggressive yield. Reducing shorts frees up margin, lowers counterparty risk, and improves resilience against sudden price dislocations. This is not a tactical trade, it is a structural adjustment. The message is subtle but powerful. The era of easy suppression through leverage is fading, and risk is being repriced in real time. Here is the hook that separates observers from participants. By the time short covering becomes visible in price action, the advantage is already gone. Early exits happen when institutions sense that the probability distribution has changed, not when headlines confirm it. Banks are moving now because they see instability forming where others still see normality. That insight is not accidental, it is earned through data, experience, and survival instinct. And in markets, survival is the ultimate form of intelligence. Institutional demand is steadily shifting away from synthetic instruments and toward physical assets. And this transition reveals a deep erosion of trust in paper-based market structures. Derivatives, futures, and complex financial products were designed to offer efficiency and liquidity, but they rely on one critical assumption: that contracts will always be honored without friction. That assumption is now being tested. Large institutions are reassessing whether exposure on paper truly represents ownership or merely a promise that becomes fragile when stress enters the system. This is not a philosophical debate, it is a practical response to a changing risk landscape. Here's the first hook you should pay attention to. When institutions that help design paper markets begin to reduce reliance on them, it signals a systemic shift, not a tactical preference. Physical assets eliminate layers of counterparty risk, settlement risk, and regulatory uncertainty. You either possess them or you do not. In an environment where geopolitical tension, trade fragmentation, and supply disruptions are becoming normalized, that simplicity carries enormous value. Institutions are not abandoning efficiency, they are prioritizing certainty. Another hook lies in the widening disconnect between price discovery and real availability. Paper markets can create the illusion of abundant supply through leverage and rehypothecation, but physical markets cannot fake inventory. When delivery times lengthen and premiums rise, institutions take notice. Moving into physical assets is not about chasing price appreciation, It is about ensuring access. In stressed conditions, access becomes more valuable than yield. Those who understand this principle move early, long before scarcity becomes obvious. This shift also reflects a recalibration of long-term strategy. Institutions are increasingly aligning portfolios with assets that perform across multiple scenarios, not just favorable ones. Physical holdings provide insurance against inflation, currency debasement, and systemic shocks that paper instruments struggle to hedge effectively. The motivation is resilience, not speculation. That distinction matters because resilient positioning tends to persist even through volatility, reinforcing the trend rather than reversing it. The final hook is psychological but powerful. Markets are driven by confidence, and confidence is contagious. When leading institutions visibly favor physical exposure, it subtly changes behavior across the entire ecosystem. Counterparties tighten terms, liquidity becomes selective, and paper promises lose their unquestioned status. By the time this shift is reflected in mainstream narratives, the groundwork has already been laid. Institutions understand this dynamic, and that is why they are acting now, quietly securing what cannot be printed, rolled, or indefinitely delayed. China's long-term accumulation strategy is no longer a background factor. It has become a dominant force reshaping global supply dynamics. Unlike speculative flows that chase short-term price movements, China's approach is methodical, patient, and strategic. It focuses on securing real assets over extended time horizons, often during periods of market complacency. That is the first hook to understand when a buyer with scale, capital, and time on its side moves quietly. The impact is felt not immediately, but inevitably. Markets may ignore this behavior at first, but institutions cannot afford that luxury. As China steadily absorbs physical supply, global availability tightens in ways that paper markets struggle to reflect. Futures curves, synthetic liquidity, and headline prices often lag the underlying reality of diminishing inventory. This creates a dangerous mismatch between perceived supply and actual access. Banks see this clearly. They recognize that once a strategic buyer locks in material, it does not re-enter the market easily. That material is effectively removed from circulation. The hook here is subtle but critical. Supply does not need to disappear entirely to cause stress. It only needs to become less flexible. Western financial institutions are now front-running this shift, not because they want to compete with China, but because they must adapt to the environment China is helping create. Front-running in this context is not about chasing higher prices. It is about avoiding future scarcity. Banks understand that waiting for confirmation is a losing strategy when structural demand is involved. By the time shortages are officially acknowledged, positioning options narrow, costs rise, and risk multiplies. Acting early is not aggressive, it is defensive. There's also a geopolitical layer that sharpens this urgency. Strategic accumulation is not just an economic decision. It is a resilience strategy. As global trade becomes more fragmented and trust between blocs weakens, control over supply chains becomes a form of leverage. Banks are acutely aware that markets do not operate in isolation from politics. When supply concentration increases in the hands of long-term holders, volatility does not decrease. It simply shifts to moments of stress. That is the hook most people miss. The most important signal is behavioral. China's consistency sends a message that short-term price weakness is not a deterrent, but an opportunity. Institutions reading this behavior understand that such demand sets a floor under the market. Even if that floor is invisible at first, front-running this reality is not speculation, it is recognition. Recognition that the balance of power in supply is changing, and those who adjust early maintain control, while those who delay are forced to react under pressure. Physical market stress is now exposing a widening gap between paper pricing and real-world availability. And this gap is where risk quietly transforms into crisis. On paper, supply appears abundant, liquid, and easily accessible. In reality, physical inventories are tighter, delivery timelines are stretching, and premiums are rising where real demand meets limited stock. This divergence is not a technical anomaly, it is a structural fault line. The first hook to recognize is this: price discovery loses credibility when it is detached from delivery. Markets can ignore that fact for a time, but they cannot escape it. Short positions depend on the assumption that assets can always be sourced when needed. And when that assumption weakens, shorts shift from strategy to liability as physical stress builds. The cost of maintaining short exposure rises exponentially, not gradually. Margin requirements increase, Counterparties grow cautious, and optionality disappears. The hook here is unforgiving. Short squeezes are not driven by emotion. They are driven by math. When enough participants realize that physical supply is constrained, the scramble to exit becomes mechanical and relentless. What makes this moment especially dangerous is how quietly it develops. Physical stress does not announce itself through headlines. It shows up in delivery delays, warehouse drawdowns, and rising off-exchange premiums. These signals are easy to dismiss individually, but together they form a pattern institutions cannot ignore. Banks understand that paper markets can absorb enormous leverage only as long as confidence remains intact. Once confidence cracks, paper liquidity evaporates far faster than it was created. That is the hook most traders miss until it is too late. Another layer of risk emerges from forced position closures. When shorts are unwound under pressure, buying is no longer discretionary. It becomes compulsory. This type of demand does not wait for favorable pricing or confirmation. It executes immediately to survive. As forced buying collides with limited physical supply, price behavior can detach violently from models and expectations. This is not volatility in the traditional sense. It is repricing. And repricing does not ask for permission. Another powerful hook lies in the behavior of lenders and market makers. As uncertainty rises, terms tighten, margins increase, credit lines become conditional, and liquidity that once appeared deep reveals itself to be shallow. This shift forces participants to hold assets that do not rely on constant refinancing or favorable market sentiment. Tangible assets fit this requirement perfectly. They do not need to be rolled, extended, or renegotiated. They simply exist, and in periods of stress, that simplicity becomes a competitive advantage. Geopolitical risk amplifies this trend. Fragmented trade relationships, sanctions, and strategic competition between major economies introduce variables that cannot be hedged easily with traditional financial instruments. Institutions recognize that exposure to physical assets can act as a stabilizing anchor when financial channels are disrupted. The hook here is subtle but decisive. In uncertain systems, resilience outperforms optimization. Liquidity that survives shock is more valuable than liquidity that disappears at the first sign of stress. Perhaps the most telling signal is behavioral. When capital begins to favor durability over leverage, the market is transitioning into a different phase of the cycle. This shift is rarely loud, but it is persistent. Institutions are not positioning for a single event. They are preparing for a prolonged period where volatility is structural, not episodic. Selective liquidity rewards those who think in terms of preservation and adaptability, while punishing those who rely on assumptions that no longer hold. In this environment, tangible assets are not just investments, they are strategic defenses against a world where certainty is increasingly scarce. The repositioning underway across major banks reflects behavior typically seen at the early stages of a new market cycle, not at the end of a temporary trade. This distinction is critical. Short-term volatility triggers reactive moves, but structural shifts trigger deliberate, coordinated adjustments in balance sheets and risk frameworks. What we are witnessing now fits the latter pattern. Banks are not chasing momentum, they are aligning with a changing environment where old assumptions about liquidity, supply, and stability no longer hold. The first hook is clear. Early cycle behavior is quiet, patient, and often dismissed until it becomes impossible to ignore. One of the strongest indicators of a structural shift is consistency across institutions. When multiple banks, operating under different mandates and regulatory regimes, begin moving in the same direction, coincidence becomes an unlikely explanation. These institutions have access to forward-looking data, supply intelligence, and stress scenarios that rarely enter public discourse. Their actions suggest a shared conclusion that the market landscape ahead will reward resilience over leverage. That is a powerful signal, and one that historically appears well before price action confirms it. Another hook lies in how risk is being redefined. In prior cycles, risk was often associated with missing upside. Today, risk is increasingly associated with being trapped in positions that depend on smooth, functioning systems. Banks are reducing exposure to strategies that require constant liquidity, stable counterparties, and predictable policy responses. Instead, they are favoring positions that remain viable even when conditions deteriorate. This is not pessimism, it is adaptation. Structural shifts do not announce themselves with collapse, but with recalibration. What makes this moment particularly important is the asymmetry of outcomes. Early cycle positioning offers optionality, and late cycle reactions offer none. Banks understand that once a new regime is recognized broadly, the cost of adjustment rises sharply. That is the hook most observers miss. By the time consensus forms, flexibility is gone. Institutions that moved early preserve choice, while those that delayed are forced into narrow decisions under pressure. The most compelling signal is the absence of urgency in these moves. There is no panic, no disorder, no visible scramble. That calm is not complacency. It is confidence in preparation. Historically, this type of behavior has preceded multi-year shifts in how markets function, not short-lived dislocations. When banks reposition at this stage, they are not predicting a single outcome. They are acknowledging that the rules themselves are evolving, and they are choosing to adapt before adaptation becomes a necessity rather than a strategic advantage. The repositioning now visible across major banking institutions carries the unmistakable signature of an early cycle transition rather than a reaction to short-term turbulence. This is not how banks behave when they are simply managing quarterly noise. These moves are measured, internally aligned, and strategically paced, suggesting preparation for a different operating environment ahead. The first hook is subtle but decisive. Banks change posture before narratives change, because by the time narratives shift, positioning advantages are already gone. What stands out is the nature of the adjustments being made. Banks are not merely trimming exposure at the margins. They are reassessing frameworks that once defined profitability. Strategies built on abundant liquidity, frictionless markets, and predictable policy responses are being de-emphasized. In their place, institutions are prioritizing durability, balance sheet flexibility, and assets that remain functional under stress. That kind of recalibration does not happen mid-cycle. It happens when institutions believe the underlying rules are evolving. Another powerful hook lies in synchronization. When institutions with different geographic exposures, regulatory constraints, and risk appetites all move in similar directions, it signals shared intelligence rather than coincidence. These entities operate with forward-looking data, stress modeling, and supply awareness that retail participants never see in real time. Their collective behavior implies a consensus forming. Beneath the surface, the next phase of the market will reward those positioned for resilience, not those optimized for leverage-driven efficiency. Risk itself is being redefined, and this is where many observers fall behind. In prior cycles, risk meant underperforming benchmarks or missing upside. In the emerging cycle, risk increasingly means dependency on uninterrupted liquidity, cooperative counterparties, and policy stability. Banks are repositioning away from exposures that fail under disruption and toward structures that remain intact even when assumptions break. The hook here is critical. Markets do not collapse when risk changes. They reprice when participants realize too late that their definition of risk was outdated. Perhaps the most revealing signal is the absence of urgency. These moves are not frantic or defensive. They are calm, incremental, and deliberate. That calmness is not complacency. It is preparation. Historically, this pattern has appeared before prolonged shifts in market structure, not before brief corrections. Early cycle actors value optionality above all else, and banks are clearly preserving choice rather than reacting under pressure. The final hook is asymmetry. Early repositioning offers flexibility, patience, and control. Late repositioning offers none of those things. By the time the broader market recognizes a new regime, costs are higher. Exits are crowded, and decisions are forced. Banks understand this asymmetry better than anyone, and their behavior reflects it. They are not forecasting a single event. They are adapting to a world where the operating conditions themselves are changing, quietly aligning before alignment becomes unavoidable. So understand this clearly. This is not about panic, and it's not about hype. It's about awareness. It's about recognizing when the foundation of the market is shifting and choosing not to be the last. To notice when banks dump shorts and move toward physical reality, they are telling you the rules are changing. The question is not whether the change is coming. The question is whether you will be ready for it. Stay alert, stay disciplined, and most importantly, stop following the crowd and start reading the signals. Because in times like these, the future belongs to those who prepare before the world is forced to catch up. Come to you.